to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey everyone, welcome back to the Daily Gold Podcast. Thank you so much for joining us today. I have another great interview for you. With me today is Bill Fleckenstein of Fleckenstein Capital. And I'm sure most of you are familiar with Bill's work, but if you think about the Federal Reserve and the damage that they've done to America and continue to do, Bill was really the first person to write about that in the late 90s. He also, I believe, coined the term bubble vision in regards to CNBC and their just absolutely ridiculous cheerleading masquerading as reporting. So for those of you who don't know, now you're well informed. So I think, Bill, you're almost like, I don't want to say you're patient zero of gold bugs and that kind of crowd who calls out the Fed and money printing, but I mean, you're really at the center of that. You were decades ahead of everyone else. So it's great to have you on. But my first question for you is, the stock market has clearly been in a secular bull since 2009. You know, we've had this move. It's gone on over a decade. It has had sharp pullbacks, but it's rebounded and moved to new highs. You know, now we have gold breaking out of this huge formation, this 13-year cup and handle pattern. And so that leads me to question, well, at some point, it seems like the stock market is this bull market that's been in effect since 2000. It's probably going to end. So I don't want to put words in your mouth, but I mean, how are you thinking about the stock market and the fact that, you know, there's been this passive bid that has kept it going? How do you see that playing out going forward in the context of now this new bull market in gold?
Well, first of all, thanks for having me. That's a pretty complex question that you ask. But let's just strip it away to the heart of the matter. The reason we've had this ongoing bull market in equities is a combination of QE, which started in early 2009, and the passive bid, which we can get to. But as it relates to gold and the whole picture, the biggest enabler that has allowed problems to fester well beyond where they would have in any sort of normal sense has been the Federal Reserve. So they enabled a bubble that occurred in the late 90s that ended in early 2000. The blow off top was precipitated by a very modest, by today's standards, liquidity injection that they made to try to save the world from Y2K, which of course seems laughable now. Took it back out, and then the market tanked, and they didn't learn their lesson, nor did investors, and they got back to cutting rates and precipitated a real estate bubble. Along the way, Greenspan managed to get Glass-Steagall repealed, and therefore the regulatory side of the banking system was passed over to the Federal Reserve instead of the government entity that had it before. So they precipitated a bubble in real estate and then didn't do their job from a regulatory standpoint. And when that bubble burst, of course, the financial system almost went to zero. So that gave them the brilliant idea of QE. And when QE came about, because I was so focused on the amount of sort of turmoil, upside craziness the Fed could precipitate, I decided to close my short fund down then, because I thought it would be more difficult to make money on the short side if the Fed could do QE. Little did I know that it would morph into what it is today. But so and then along the way, as we did QE, and then in the wake of in the wake of the lockdowns and the insanity that prevailed in that period, of course, we had even more QE. They held rates at zero too long. It completely screwed everything up. I'm speaking about the Fed. But because of the monetization of all the things they did, that allowed a tremendous amount of can kicking. on the part of the government, to where now we're running these monster deficits, bigger than we ever have, obviously, which has always kind of been the case, but they've gotten to be epic proportions. And part of that has been, no, a lot of that has been facilitated by Fed policy. And so we never get around to attacking the problem when it might be solvable. We just wait till it gets out of control. Of the banking and real estate bubble that we went through, and the blow up in 08 was a good example. So here we are. The passive bid has warped the equity market, and when you combine that with QE, even though now we're supposedly doing QT, which was kind of offset by the BTP, or whatever they call it, the bank bailout fund that now has been termed out to a year from today, or a couple of days ago. All of that has precipitated this wild environment. But meanwhile, we've got this monstrous budget deficit, which is whatever it is, pick a number, 5 to 7% of GDP. And so we have the Fed raised rates a lot and made everyone feel that we're going to have a recession, but the stimulative effects of the budget deficit has sort of stopped that to a large degree. And we're in more of a stagflationary period. And what's interesting is the bond market seems to be more focused on Fed policy than inflation. By that I mean, if Powell came out tomorrow and said, "Hey, things look so good, we're cutting 50 or whatever, 25, 50, doesn't matter," I believe the bond market will rally. The bond market is focused on the Fed policy as though the Fed policy is the correct policy, and it's going to be good for bondholders, when in fact the Fed policy is bad for bondholders. So what I'm really looking forward to is when they get around to rationalizing the inflation level and the inflation rate that's not gotten back to where they thought it was, and of course they were wrong about it being completely transitory. I mean, the pig went through the python, but the price distortion is still there in a lot of in most places. So I think then that will start to call it, the Fed will finally start to lose some credibility. I think that's in the process of happening. And maybe that's why gold finally decided to take off, a week or so ago, whenever it was, after going sideways for 5 weeks above 2000. It just went, right? There was no real reason for it to go. And those are always the best moves of all. You noted the massive cup and handle that you could put on a chart 50 feet away and see. That's a pretty powerful, I'm not a huge technical analysis type person, but that's a pretty powerful signal, and a lot of people have seen it and are aware of it. What's interesting is that you mentioned the GLD, and there have been almost no inflows into the GLD this year. Yesterday there was a little one. There was a little one a month ago. There may be about 3 itty bitty like inflows. Mostly it's been outflows, as I'm sure you know. All the bullion has been bought by Asians and Indians and central banks. So the North Americans have yet to join the party, so to speak, and all this has gone on, without them. Having said that, in the last 2 weeks, the futures complex has piled up quite a lot of contracts, and the open interest is, moved up by about 25%. I mean, open interest went from 500,000 contracts down to like 415. Now it's back to 540. Sometimes in the absence of any physical buying away from that, obviously that would set the stage for a decent sized correction. When we get that and how big it is, I don't know. But that's kind of the big picture that gets us to now, I think.
Yeah, to follow up on GLD, when do you think, it's nobody knows the real answer, or we're just guessing, but when do you think we're going to start to see inflows in the GLD? Do you think it will take higher prices and kind of a momentum thing, higher prices in gold, or could it be some other fundamental development where the Fed actually goes ahead and cuts rates?
It's hard to say, because I would have thought that there would have been more enthusiasm by now, because the price did break out and has started to go, and instead we've just seen steady liquidation. So maybe it will be when the Fed makes it even clearer that they're going to cut, I mean, assuming that's what's going to happen, they may not actually be able to. I don't know. So it's hard to guess at what might move the needle in terms of getting people to do something, since they've been so reticent to do it. I know it'll happen because inflation's a problem and it's not going to be cured. Now, obviously, a lot of money is out speculating in
Crypto.
crypto, in the crypto universe. So that's probably stolen some of the thunder, but not everyone is a huge crypto fan, and not everyone who's a crypto fan doesn't think they should own some precious metals. So I don't really have a good answer for you, because I would have thought it would have started in the wake of the move that we've seen, and thus far it really hasn't. I mean, so I can't really. I mean, when it's clear that the Fed is not going to get inflation back under control, to, I guess, some of the slow learners, maybe then it'll happen. But I wish I knew. I just don't.
Yeah, I mean, two follow-ups on that. But first follow-up, couldn't you say that gold's breakout, that's really the first signal that the Fed's not going to get inflation under control?
I think, yes, that's the first clue that at least a lot of people believe that's going to be the outcome. Yes, or enough people to move the gold market. Anyway, yeah,
Right.
yeah. I think it's a pretty strong signal.
Yeah, and the other follow-up I have is, earlier you said the best moves are the ones where nobody knows why it's moving or breaking out, like we've seen
Correct.
in gold. And
Correct.
so, yeah, I mean, can you recall a similar experience or similar market movement any time in your career? Maybe draw a parallel somewhere, maybe not.
Yeah, I can remember times where not understanding why something was happening, and later finding out. The most vivid one for me is along that line of I was short the Tokyo stock market in 88, 89. And in the very beginning of 1990, that market didn't rally. And it always rallied in the beginning of the year. And I thought, wow, that's pretty important that it didn't rally. And I increased my short position, and the timing was pretty good. So I just use that as an example. I mean, the market broke, in this case, the market broke down for no reason at all at a moment in time when it always rallied. So there was no reason for it to go down, especially since it always went up in the beginning of the year. So there was that one sticks out in my mind vividly, because it was my first really big score in a speculative sort of sense. So I'm sure I can think of some others, but I mean, I just know it's happened to me over and over in my career, but that's the one that comes right to my mind.
No, that's a great example. Following up on that, let's talk about bonds. And I mean, I think we're based on my data, we've already got into a new secular bear market in bonds. Can you talk about, and I think in another interview, you said this is a generational bear market.
Yeah.
Because bonds do move in a generation, once in a generation, you could say. Can you talk about the impact that's going to have on precious metals, but also capital flows in general? I mean, we still have a lot of money going into stocks and tech stocks and that sort of thing, because and you still hear on Bubble Vision like, oh well, higher rates is bad for gold, even though the rates have gone up in the last 5-6 years and gold just broke out. So I don't,
Right.
I just the nonsense continues, Bill. But I guess I'm just looking for kind of a more greater perspective, a wider view on the significance of bonds going into a secular bear market. I mean, I think part of why gold held up recently is because of the secular bear in bonds.
Yeah, the bond market moves are generational. You can just go look at the history of bond yields. My career sort of, when I first got into the business in 1980, it wasn't very long after that before, long rates hit 16% on governments, and short rates were in the high teens, and then I've seen them go from there to zero. So but I think the bond market still believes in the Fed. If you notice, I started to talk about this earlier. The bond market seems to, if the Fed said we're going to cut, the bond market would probably rally because okay, lower rates are good because the Fed knows what it's doing. What I'm looking for is when they cut rates and shortly thereafter bonds decline. You get a 3-day rally, 5-day rally, and then they start declining. People say, why are bonds going down? I mean, the Fed just cut. That'll be the sign that the Fed is losing credibility. And when that happens, the world's going to change for real. In that period, gold will really go crazy, I think, despite what the Fed does, because that will be the bond market's way of saying we don't trust the Fed, nor should it. I mean, the Fed should not have the credibility that it currently has, but it does. So I think when they cut, how the bond market responds is going to be a real key. And should it play out like that this time, whenever it occurs, then I think that'll be the sign that gold's really going to bust a move,
And so you're talking about long-term bond yields.
Yeah, or say 10 years and out, yeah, not the short end of the curve. The short end of the curve, of course, gets dragged around by the Fed. But I'm saying, bonds where inflation risk matters, right? You want to lend somebody money for 10 years at 4%. I don't.
Is there a level? I mean, can we quantify that when long-term bond yields can become a serious problem? Because just looking at various market movements over the last century or so, I think in the mid to late 60s, you had that move in long-term bonds in 66, 67, kind of in that period. Once it got above 5%, it really slowed down stocks. And I noticed in the last couple of years when the 10-year was rising, when it made that move up really close to 5%, the market was selling off. So it seems like we're in a new paradigm where if we're having these, at least if you look carefully at the price action in the last 3 years or so, when long-term yields are moving up and bumping high, the market has not done well. So do you think we're quietly entering a new regime there where stocks and bonds are more correlated now?
Yeah, well, I mean, normally, all things being equal, rising interest rates are negative for valuations, right? It's just a net present value type calculation. So, but then there's also the economic consequences of rising rates and what that means. And I think when the Fed, finally got around to raising rates and raised them so fast, people were reacting to the change in the discounting function that came as a consequence. But they were also worried about the recessionary consequences. And then because of the size of the stimulus, budget deficit stimulus, we didn't really get a recession. So now people are feeling like, well, rising rates didn't matter, and now maybe they're going to cut. And so you've got this a little bit of the, when the Roadrunner, from the Wile E. Coyote cartoons, when the Roadrunner runs off the cliff and doesn't go down at first. I mean, I'm not saying the bottom's going to drop out of the economy. It's a very kind of unusual taffy pull situation where you see a lot of tech stocks laying off. Sorry, a lot of tech companies laying off employees, but you've still got an okay labor, a reasonably stable labor market. Now, I don't believe the BLS, not because they're purposefully making the numbers up, but just the way they calculate them. I think their birth death model calculations are wrong. That's why the revisions are all lower.
By the way, sorry to interject. Have you seen the revisions the last couple months? Those seem to be some pretty extreme. I mean, they're always revised, as you know, but the last couple months, I mean, those in particularly look to be massive revisions.
Yeah, I think that's because the birth death model is so far off where reality is. But I mean, again, the way we trade the unemployment or the non-farm payroll report is absurd because it's a wildly revised lagging indicator. I mean, I thought we were supposed to be investing for the future, not the past. But in any case, that's the way the market trades it. So that's the way you got to look at it, right?
Right. Yeah, let's talk more about the economy. Do you think we're at the point where if the Fed cuts rates and maybe some more fiscal comes in, that they can I mean, prevent a recession? I mean, albeit it would lead to stagflation, but how do you have any view on where things could go over the next year or so? It kind of it seems to me they're kind of getting ready to, with with Biden's comments about 100% they're going to cut rates, and then the Fed funds futures are reacting to that. It seems to me that they're kind of, at least if they think things are going to drop more with respect to the overall economy, that they're going to try and get in there and stabilize and reflate everything.
Yeah, I think we're in a stagflation period now. Real growth is pretty meager, and inflation is running higher than real growth. To me, that's the stagflationary environment. Nominal growth is higher because there's enough inflation. So I think we're in a stagflationary period, and that's why it's not pure recession, it's not pure growth, it's just this kind of mess. Hasn't been recognized as that. But part of the problem is because of the passive bid, the stock market doesn't work the way it used to. It's not quite the same discounting mechanism that it always was, because you've got this mindless set of cash flows that come in every day as a result of corporate retirement money. I mean, that gets put into the market via Vanguard and BlackRock. And if they have contributions, they buy. I mean, there's no decision making; it's just automatic. And so it helps keep the market up. Whereas in the past, maybe the market might react negatively to a piece of news, and on any given day, a piece of news may come in, but the passive buying may swamp it, and people stand back and say, it's not so bad because the market didn't react. And so you get this warped function, warped discounting mechanism that doesn't work like it used to. And so it gives people a false sense of confidence. So I think the combination of passive and QE has made the stock market almost a lagging indicator instead of the leading indicator that it used to be. Not totally, but there's not much discounting done by the market. My favorite example was go look at Q1 of 2020. I was writing columns in January early about the problem in China with COVID and what it was doing and what I feared may happen. And the stock market didn't care until all of a sudden got hit over the head with it in March 2020. So any real market would have looked forward and saw it coming and started discounting it before it happened. So anyway, I don't think the stock market is exactly the same stock market that I grew up with.
To follow up on that, yeah, because I mentioned secular bull, secular bear at the beginning, and you said we're in the stagflationary period. I mean, can that keep the market maybe more elevated than it did in the late 60s and 70s because of this passive bid? Or do you think that passive bid, another better question, I'm sorry, I asked like 5 questions at once.
That's okay.
Better question. I mean, could that passive bid, when they start to realize that, okay, we're in a stagflationary situation, where is that money? Is it going to go into tips, a little bit into gold, or?
No. There's no real discretion with it, right? I'm not the expert on this. Mike Green is. But the way it works is you go to work in corporate America, your money goes into a target date plan, right? And if you're a young person, it's 100 could be 100% stocks, 90% stocks, 80% stocks. So every month, that money, your retirement money, is going into the market. You don't have options really you may have some options for some portion of it, but most of it is, it's a target date plan, and it's automatically, the only way that would unwind is if there was enough layoffs such that there was a smaller volume of money going in at a moment in time when the market cap of the market was big enough that it needed a certain amount. Look, when the market gets bigger or a stock price goes up of a business, the market cap increases, and it generally takes more money to keep that up. And so, given the fact that the market cap of the market is so big now, perhaps we could get to some level of unemployment that would mean that enough people in corporate America had lost their jobs that the amount of money flowing into passive daily might not be big enough, and you could have a market crack. You'd have to look for signs of that in real time. I don't believe it'd be predictable in advance. I mean, you could recognize it was starting to happen and get prepared, but you can't say, well, this, and this, and then it'll happen. It's going to be it would be a function of employment in corporate America purely.
To circle back to the economy and stagflation, I mean, assuming that's where we're headed for a longer period of time, how do you think this round of stagflation and this gold bull market will be similar or different to what we saw in the 70s, if at all?
I have thought for a long time that we were headed to a replay of the 70s, a variation, because things were never exactly the same. We've in the early 70s, there was the Nifty 50 one decision stocks. That should ring a bell today for people with the Magnificent Seven or whatever we call them, whatever the latest moniker is. So there's that real narrow leadership and this absolutely absurd valuations for these businesses. I mean, so that's an interesting similarity. And you have people who aren't worried about inflation, who think it can't happen. And I think that's a little bit of how the early 70s unfolded. And so I think there's a high probability that we'll replay a variation of the 70s. The size of the deficit is so enormous now, that's different. I don't think there's the CapEx that's going into energy that did in the 70s, which helped us later on. So I think the period is going, whenever it starts to get kind of unfriendly from a financial standpoint, it's going to be way worse and last a lot longer. I mean, 73-4 was pretty brutal in the equity market and the economy, but the real pain came in late 79, 80 when Volcker was forced to pursue rather draconian measures and focus on the money supply, which took rates to the moon. So we couldn't do that today. The deficit's too big. So I don't know how that's going to play out, but the Fed's never going to be able to tackle inflation the way Volcker did, even if you had a guy as strong-willed as Volcker, which Powell isn't. So that's another reason why gold's starting to sniff this out, I believe. I mean, you can see the non-G7 central banks got the joke about 2 years ago. They started buying gold on a very regular basis, right? And the Asians have done it. But Americans haven't tumbled to it. They're too busy chasing stocks and tech stocks in particular, and crypto, which is a variation of the same theme.
Do you have any thoughts on where this gold bull market could end? Because I was thinking the same thing that you said, that, I mean, they can't, we know in the end of the 70s, they were able to raise rates and crush everything. They can't do that today. So to me, that, I don't know. I just don't see. I only see the bull market and gold ending when gold gets reintroduced into the monetary system some way, somehow. I don't know how else it's going to end.
Well, it could end in in some variation where the bond market stops trusting the Fed, and because the bond market didn't trust Volcker. By that time, nobody believed the Fed at all. So if you have a real guy come in or a gal come in to try to do the right thing, the bond market might not trust them. And look, at some point, they're going to have to do something on the budget. I mean, you can't run these size deficits for. So I don't know what kind of a train wreck we're headed for. I always thought that when the bond market finally took away the printing press, which is the process I'm talking about, somewhere deep into that period, you could sell your gold, and let's say for some big number, whatever it is, and then you could go back to treasuries, because if the bond market doesn't trust the Fed, they're going to create a real spread that is enticing. So let's say inflation's 5 or 6. Let's say bonds are 12 again. Now, of course, the U.S. government doesn't want bonds to be at 12, and the Fed doesn't want bonds to be at 12, but they could be 11 or 12%. So you could get a real rate of return that's attractive. I'll tell you a story. In 1984, the economy was, had been doing pretty well post Volcker taking rates down. And in 1984, the bond market decided that the inflation was coming back. And even though the inflation rate, I think it was, somewhere 5 or 6, maybe a touch higher for a little bit in that period, rates backed up to 12% again. because the bond market didn't trust the Fed. This was 84. And I remember we were buying zeros in equity accounts because the rate of return offered was attractive, and we didn't believe inflation was coming back. So there's a real live example that I lived through where the bond market said, nah, we don't trust you. We don't believe you. Well, I think we're going to get into a period where the bond market, so all of us that have owned gold for a long time for protection purposes, we'll probably get the luxury of selling a bunch of our gold if we want, or some of it, not all of it, or however much you want, for very attractive treasury coupons where the inflation rate will be, one number, and maybe the coupon will be twice that or something. So that's always been my view of the end game. But that doesn't mean it's going to play out that way just because it's my idea. But that's my favorite scenario. And there'll be a train wreck because rates get very high. The budget deficit. I mean, the amount of interest on the budget deficit is going to be more than receipts. I mean, it's just crazy.
Yeah. Okay, Bill. Well, you've covered a lot here today. Is there anything else you want to touch on that we haven't covered?
Not that I can think of.
All right. Well, we'll have to leave it there. Bill, if you want to direct our listeners to your website, how they can follow you on Twitter. I know you tweet a little bit. If our listeners and viewers want to follow you, can you point them to that path?
My Twitter handle is @FleckCap, and my website is fleckensteincapital.com. I charge $130 a year for writing a column about the market every day, and I answer questions. I've been doing the same thing on that for 25 years now. And I priced it very reasonably so that anybody could afford it. And I decided when I first did it, I thought, well, people aren't going to pay for it. I'm not going to do it. But I wasn't really trying to make a lot of money on it. I just didn't want to write for nothing.
All righty. Well, on that note, Bill, thank you so much for coming on. Really appreciate it. Hope we can do this again over, who knows, like a quarter or two or at the end of the year.
Sure. It was fun. Thank you.
Okay. Thank you, Bill.
Thank you for tuning into the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.